You're watching Global Insight, where we speak to experts from around the world on issues making headlines. I'm Also Young. The US Federal Reserve has been trying to chase down inflation for months with a series of inflation rate hikes that are having ripple effects across the global economy. The Federal Open Market Committee on Wednesday again raised the federal fund rate by half a percentage point to 4.25% to 4.5%, saying that it was highly mindful of inflation risks. Now, we discussed the latest decision made today by monetary policymakers in their December meeting. And for this, we're joined by Randall S. Krozner, the Norman R. Bobins Professor of Economics at the University of Chicago Booth School of Business, and Sei-wan Professor of Economics at Ewha Women's University. Very warm welcome to you both.
Morning.
Good morning, and good evening to you, Professor Krozner. My first question goes to you, actually. And what did today's Fed announcement indicate to you about what policymakers have in mind in terms of the speed of their future rate hikes?
So I think they made it very clear that they're going to continue. I think a lot of people in the markets were hoping that because the inflation print was a little bit less strong than they had expected, that the Fed would say they're going to stop. They're not going to stop. They're going to keep at it until inflation is very close to their 2% target. And so they left themselves some wiggle room for the next meeting, which will be on February 1st, whether they're going to raise rates by 50 basis points like they did today, or 25 basis points. It really depend on how the labor market is looking, how wage pressures are looking, and how inflation is looking. So I think they're going to keep at it. I think they're going to keep raising rates until they get to roughly 5%, 5.25%, likely stop and take a pause. But then they're going to keep those rates at that level through most of 2023.
I see. Professor Krozner, well, what's going to be the impact then of the Fed's rate decision today on the US dollar?
And so obviously the strength of the dollar has been driven by the Fed driving interest rates so rapidly up. And I think this is broadly in line where market expectations are. So this will keep the dollar relatively strong. It's off some of its highs from a few months ago, but it's still much stronger than it was at the beginning of the year. And I think it's likely to stay fairly strong through 2023.
See, and Professor Kim, now, what do you think is going to be the impact of the Fed's decision on Wednesday, Thursday, South Korea time, on the South Korean currency?
First of all, it is extremely difficult to forecast the exchange rate in the short run in economics. But along with Fed decision today, the key interest gap between U.S. and Korea became 1.25%. So I would say current $1 exchange rate of 1,301 per dollar will be maintained by the end of this year. The U.S. dollar actually has been appreciated against almost all currencies in a large scale in the second half of this year. That was mainly driven by Fed's rapid interest rate hikes, represented by 4 straight times of giant steps, or 0.75% increase. In early October, $1 exchange rate picked up to 1,441 per dollar level, but it declines as U.S. inflation pressure slowly fades out. And it indicated lower possibility of further giant steps, and naturally $1 exchange rate declined down to 1,301 per dollar level in a month. All these declines of $1 exchange rate has been carried out with about 1% base interest gap between Bank of Korea and U.S. Fed. Since Korean economy is under about the same base interest rate gap until next year interest rate decision in January, the exchange rate will go ups and downs around 1,301 per dollar until early next year.
I see. And Professor Krozner, well, the whole point of this has been to really chase down inflation. And it seems, though, that the job market continues to be very robust, as well as consumer spending in America. So do you see inflation cooling off next year?
So I do think inflation will be coming down. I think we've passed peak inflation, unless, of course, there's some sort of additional global shock. Unfortunately, I think we are in a very risky time for global shocks, whether it's something related to Russia and the Ukraine, or with tensions between China and the West, or in the Middle East. But let's put that aside for a moment. I do think inflation is going to be coming down through the year, but it's not going to get anywhere close to 2% by the end of next year. The Fed is now forecasting that by the end of next year, the inflation rate will only come down to about 3%. Well, they ultimately want to get down to 2%. So I think what that means is they're going to continue to keep interest rates reasonably strong. And I think one of the reasons why the inflation rate is going to be slow to come down is because the job market is still very strong. Even though the Fed has been raising rates quite rapidly since March, the labor market has not yet cracked. So the job growth has been very strong. Wage growth has been very strong. The challenge is that wage growth at around 5%, well, that's now below inflation. If inflation does get down to, they're trying to get it down to 3% or 2%. If it persists at 5%, that means that all of the labor costs, and in particular in services, in services, that's a very high percentage of total costs. But all labor costs will be going up at 5% rather than at the rate that they're hoping to bring things down to. And that's why I think it's going to be slow to come down, because these wage costs are going to be slow to cool off. And that's going to be the key thing, I think, driving the next stage of inflation.
I see. And well, Professor Kim, the Bank of Korea policymakers, they're going to have their first meeting of the year on January 13th. And what indicators do you think they'll be observing very closely to decide on the policy rate?
Well, Bank of Korea's base interest rate decision will be much affected by U.S. Fed's decision today. Because as we talked about, Bank of Korea should maintain a certain level of interest rate gap with U.S. Fed for protecting the value of Korean won. The December interest rate of U.S. Fed at 4.5% leaves the Bank of Korea on track to lift interest rate by 0.25% in January interest rate decision, which makes Bank of Korea's base rate 3.5%. Another important figure that we should pay attention is price level and its growth rate, which is inflation. It is believed that Korean economy is passing through the peak of both price level and inflation as of now. July's domestic inflation was 6.3% on year at its highest level in 40 years. After that, inflation is declining down to 5% on year in November. If price level goes down further in January next year, Bank of Korea does not necessarily raise this key interest rate by 0.5%. It means that a 0.25% base interest rate hike is much expected as of now.
I see. And Professor Kim, well, because of these very difficult financial conditions that we're in, both households and businesses in Korea, there are growing concerns about stagflation. So what is your view on this?
By definition, stagflation is a combination of high inflation and low economic growth. And Korean economy is experiencing the highest inflation since 1980s at over 5% from April of this year. And in terms of economic growth, Korean economy is cooling down quickly. This year's economic growth would be about 2.5%, but every economic institutions, including government's largest think tank, KDI, forecast next year's Korean economic growth would be 1% level. It means that Korean economy's growth momentum is quickly weakening due to higher interest rate, slow global economy, declining export, and so on. In this respect, we can say that Korean economy enters the early stage of stagflation as of now. I'm sorry to say this, but next year, therefore, will be much worse than this year. In next year, over 4% high inflation will be continued until the end of first half of the year. And economic growth will be cut about 1%, which is a huge economic downturn.
Well, that is a pessimistic view, but we do have to be realistic, I suppose. And in that sense, Professor Kim, then what does the ongoing financial crunch really mean for low-income households and people on very stagnant wages, including myself, in South Korea?
I'm glad that you raised this point, Seung. What we learned from history is that when economic shock comes, there always goes income gap between between the rich and the not. So there's no question that the hardest hit by current economic situation of high inflation and slow economic recovery is the low-income households. For example, the bottom 20% income households expense on food exceed 20% of total income in Korea. The food prices increased in the largest scale from last year. That means that the low-income households are suffering very much.
Right, and it's very concerning, and hopefully we'll see some government measures really address this, very targeted measures that we need.
20s and 30s are also hit hard by slow economic growth. Recently, the new jobs were mainly created in the manufacturing, accommodation, restaurant, and healthcare industries, apparently on the back of eased social distancing. But we still see continuous weak employment opportunities for young workers. The employment growth was mainly led by those aged 60 and above, which account for a whopping 70% of on-year gain of the jobs. The new jobs addition for those in their 20s and 30s only 4%.
That is very concerning indeed. Not very balanced level of additional jobs there. And Professor Krozner, well, for the US, it is, of course, the Fed's target to reach 2% inflation. And, well, what is it really going to take to reach that level?
It's going to take a while. I think inflation took a while to build up, and it's going to take a while to come down. The Fed's forecast themselves that they put out today suggests that they're not going to be able to bring inflation down to their 2% goal until 2024, maybe even 2025. So it will take time, and I think it'll have a lot to do with the labor market, that we want to have robust wage growth, but it has to be in line with where inflation is going to go. And so ultimately, wage growth will be about the base inflation rate, hopefully getting to 2%, plus productivity growth. The challenge is that productivity growth has been relatively low recently, and so we really can't have wages growing much more than 3% or so if you're going to have 2% inflation, but productivity is only growing around 1%. So the 2 plus 1 getting to 3. But wages are growing at 5% now. And so that is going to make it very difficult for the inflation rate to come down because, as I mentioned before, labor is a large part of the services economy. It's a large part of the economy in general, but particularly the services economy, which is the majority of the U.S. economy. And so that is something that's going to take a while to bring down. And so I would agree with the Fed's forecast that they probably won't get to 2% until 2024, 2025.
I see. So that's quite a challenge for Fed there, trying to chase down this inflation. And while that was Randall S. Krozner, the Norman R. Bobins Professor of Economics at the University of Chicago Booth School of Business, and Kim Sei-wan, Professor of Economics at Ewha Women's University. Again, thank you both so much for your time today.
Thank you very much.
Thank you.
So thank you very much to our viewers for tuning in. Global Insight will be back on Friday, South Korea here. And well, wherever you are in the world, have a great day. Bye.